it's time for critical thinking. And
Okay.
what do you have?
I like this part. Okay, so this week I want to talk about credit versus debt. Not debit, like as in credit cards versus debit cards, but credit versus debt. Credit makes the world go round. It provides liquidity. People can borrow and repay the money very quickly, as in overnight lending for banks, and it allows transactions to be facilitated. I use an American Express card all the time. At the end of the month, I pay it off. I never have to worry about if I have enough cash with me, I can just use it. It facilitates transactions. That's credit. Debt, on the other hand, is owing money to someone. So if you don't pay your credit card off all the time, that's debt. Or if you borrow money in a house, that's debt. So there's a difference between the two. Credit right now is having a problem, especially in Europe, because they're not lending to each other. And if you don't lend to each other with a bank, overnight it can be a problem. So the overnight lending, the story was that they're in trouble.
It says that the Eurozone banks' use of emergency overnight European Central Bank lending has surged to almost 5 billion euros, the highest in more than 7 months. The jump in use of the ECB's marginal lending facility to 4.8 billion euros on Tuesday night highlights the financial market tensions ahead of this weekend's European summit meetings.
So the central bank...
They can't lend to each other, so they're going to the central bank.
That's right. So I don't
And-
trust Brenda. Brenda doesn't trust me, so we got to go to Dad. That's what they're doing.
And
because
Dad's
we don't
paying out a lot of money right
well,
now.
he's lending it to them. They're going to pay it back. He's lending it to them. So it's only overnight lending, so it's not terribly risky. It's just that Brenda owes money one day and I owe money the next, and we don't trust each other, so we won't lend to each other. We have to go to Dad. That's essentially what's going on there, and that's a problem. Without credit, we have a problem in the world because everybody, not everybody, but all the banking system essentially runs on credit. You have to trust the other party will pay you because you're not actually getting the cash. If everybody had to pay with cash, we would have problems.
Oh, there'd be a lot of wheelbarrows going back and forth.
That's right. It'd be tough to buy a house. So credit is important. The difference between credit and debt is credit is simply, I borrowed some money from you, now I pay it back. Like an American Express card. I use my American Express card all the time. I charge everything with it at the end of the month. I pay the bill. Gives me a nice record of what I've got. Doesn't charge me any interest. Doesn't cost me anything. It's very convenient. So that's how I use credit. But I don't have any debt on it. There's nothing I owe. I owe at the end of the month, but it's for stuff I already bought. I don't have a loan. There's no loan on it. So debt is different than credit. And even though we call them credit cards, they're not credit cards. They're not credit. You know, credit sounds like you're getting something.
Right.
It's credit. That's good.
You're getting the goods.
It's a debt card. Is what it is. You're going into debt when you use it, so you don't want to use it. So think about this in the world. Where would we be without credit in the world?
Not very far.
That's right. There would be no liquidity in the world. It'd be hard to do transactions. Now think about the impact of debt in the world. What kind of debt problems do we have? Greece, total debt problem. Why? It borrowed too much. That's debt. That's not credit. Lending money to Greece and having Greece pay it back is credit. Borrowing money and holding on to it and then not being able to pay it back is debt. And debt is a big problem. And if you think about your own life...
Well, we've had it here with all of these homes.
Of course. Homes.
Right.
You borrow money, now you have debt, and you can't pay it back, and all of a sudden they got to foreclose. And that's a huge problem. And we have a United States government federal budget problem that is huge debt. Lots of zeros and commas in that one. State of California, not exactly the most fiscally responsible entity I've ever seen. So that's debt. It's not credit. So you remember the difference. It's great to have credit. You want to have credit. You want people to trust you so you can borrow short term and pay them back. Or you can even borrow long term for a house or other appreciating assets. Now, what is debt? What do we think of as debt?
Leverage.
Debt is leverage. So we use leverage, and we know that whatever we buy with it is going to escalate in cost, or in price. So if we buy a house and put money down and the house goes up in value, we've made more money because we use debt because it's levered. If it goes down in value, we lost more money because it's levered. Same thing's true when you use your...
Positive or negative?
When you borrow money to go to the movies, that movie costs you more because the movie's gone and now you owe interest on the movie tickets. So when you think about debt and credit, you want credit, but you don't want to have bad debt or debt that is not going to be escalating or appreciating in price. So that's the big difference, and it applies not only to our government and their government, but to you and me and all of you also. So that's the difference between credit and debt. You want to be able to borrow money and pay it back. What you don't want to do is have debt that you're paying interest on all the time.
And what's your takeaway?
The takeaway is having access to credit allows life to move along fairly smoothly. But having debt means that you are leveraging the outcome of what you use the money to borrow for. Having great credit and only debt on appreciating items, you'll be financially better off.